a very crucial role in accounting for the products and services that are traded on in the financial services industry, because there are high level of volatility between, say, the key variables that determine fair value, and that would be the effective rate, which is the interest rate that is, say, the London interbank rate, or maybe the rate issued by the respective country's central bank. In my country, there's a published rate on the website of the central bank. I think in most countries, so you go to the central bank website, you will see both the exchange rate for a particular date, and you will see the interest rate for lending and borrowing in a particular financial instrument, whether cash or whatever financial instrument that is traded in the various markets. So the standard is clear here. The fair value is the price that you will receive to sell your assets. So, and then, of course, that has been a problem in most accounting, as well for taxation purposes. Related party transactions, those do not count as fair value because they are related party. The key word there is independent party, because if the market participants are not independent, they could manipulate the value of the transaction, and that's going to affect either the gain or losses that will also go to the profit and loss, from which the entity going to pay taxes. So in most jurisdictions, there have been a disallowance of transaction value between related parties. So we normally use the value as if that transaction has occurred between unrelated parties. So it has to be an orderly transaction. What does that mean? It has to be orderly because it has to be formal. So it's not just some intuition. All right. So it has to be formal. It has to be agreed between the party for either the sale or the transfer of the instrument. And then insurance. So insurance, like we said, play a major role in the financial services industry because they provide protection either for death or property or accident. Now, for the insurer, you have to recognize each element of the contract. Basically, there are 4 elements on the contract: the initial asset received and the associated liability. Those are the 2 initial recognition. How you recognize it as an asset, subsequently is different from the initial recognition. So initially, if you receive cash or other variable financial asset, it's recognized initially as a liability, because we say as much as there have been no occurrence of any provision as stated in the contract, that amount becomes a liability because there's a future likelihood that you could pay for insurance claims as in accordance with the insurance contract. But basically for IFRS 17 is the valuation of the future cash flow. Now, future cash flow could be either a payment to the insured party or an additional payment from the insured party. So how is that amount going to be recognized? Now, once it has to do with future cash flow, then you talk about discounting. And the major issue in discounting is the discount rate. So how do you determine that discount rate? So there are 2 methods, either the top-down approach or the bottom-top approach. The bottom-top approach is to use what we call the risk-free return, the risk-free rate of return, which is the rate on risk-free assets like treasury bills or highly liquid government bonds. So that's the first thing. So the reason for that, then you have to do what we call adjustment. So the initial position for that discount will be the risk-free rate. And any adjustment will be, say, the insurer own a version of risk, so-called risk adjustment. So the initial base will be, the base rate will be the return on risk-free rate plus any additional adjustment that will be due to other the insurer own aversion, risk aversion, or other non-financial risk, say the risk that they claim may be more than the initial asset recognized on the contract. And that rate has to be, that cash flow in the future has to be discounted and reported now, and then carry forward as the terms and the time expire or the time event expire. So also on IFRS 17 is the requirement for the presentation, because we talk about the initial recognition, the subsequent recognition, and the measurement, how it should be measured, fair value or cost. Well, mostly for most financial instruments that have to do with insurance, other maybe an embedded derivative within an insurance contract, that amount will be separately valued at fair value. But there are other conditions based on the parties' agreement. There could be some provision where the amount receivable or payable in the future is contingent on the occurrence or non-occurrence of some uncertain event that's outside the control of both the insured party and the insurance company. So in that case, you use a stochastic method to do that valuation, which is above, that is actually for valuator, actuaries and stuff. So in actuary, there's a valuation you use to determine that particular embedded derivative as a financial option that arises as a result of the contract. So that was the bottom top approach. The top bottom approach is basically to use the effective rate as if that amount had been borrowed from the open market. So if the amount that is paid by the insured party to the insurance company, the discounted amount or the amount that going to be paid to the insured party, assume that you're going to pay that amount in, say, in a year's time. The standard allow you to determine that future discount rate that will be applicable to that transaction, and then you can discount that future cash flow back to current value so as to recognize other unassociated losses or gain thereof. And you're going to have a gain if the amount payable is more than the asset, or you're going to recognize a gain if the amount payable is less than the asset received, or a loss if the amount payable is more than the carrying value of the asset received or receivable, whatever case it applies. And of course, there are disclosure requirements, basically in terms of the risk associated with this contract. They have to be reported in the notes to the financial statement. Now, for auditors, it's key to understand this provision and the specific cases in which they apply, because if you went to audit, say, a fund manager, and that fund manager is using complex accounting methods that you don't understand, the provider, even assessing the compliance with that standard is practically to none. So the best thing as auditors we can do is to sorry for that, please. I was interrupted. So yeah. So if you went to audit an organization, whether a commercial bank or a fund manager or private equity fund, the best you can do as an auditor, now the best auditor is one who understands the accounting standards, as well for financial auditors, because it is practically impossible to audit an organization that you have no understanding of. So it is important for us as auditor to understand the accounting provisions and how they apply. Now, trust me, these accounting standards are among the most complex accounting standards that have ever been issued by the International Accounting Standard Board, basically because the complexity of the products and services that are traded on in our industry, especially for those that are in listed exchanges, all right? And we know that Ghana has an exchange and Nigeria also has an exchange. But if that is not the case in your country, you still need to understand those relevant provisions that apply, say, to commercial bank or to insurance companies or to private equity funds that are managed by some local managers. Where I am, there's no power, but I think you can still hear my voice, possibly if you have your. So there are a few questions. I want us to just, maybe the participant can partake, or maybe I can just give what knowledge or experience as it relates to these things, especially for tax purposes. So you say, how will accounting standard affect the amount, timing, and disclosure of financial instruments for tax purposes in the following circumstances? All right. Yeah. So, example, a commercial bank. Okay, I've just been told that I'm out of time, so I will allow the participants to take this question, and maybe we can discuss it when we have time, or you can send your question to the question and answer, and either me or Inola will be able to provide you additional insight or opinion if possible. So thank you very much for listening. And if you have questions, I will take your question. If you don't have questions, then I'm very grateful for your attention. Thank you.
We'll give a few minutes for questions, and then.
So, Mr. James, you can respond to your questions, okay? You can go ahead to respond.
Yeah, questions, all right. All right, so in the event of mobile banking, what are the mechanisms used in Nigeria to reduce risk on tax avoidance? So this is for Nigeria, so I will allow the Nigerian man to respond. Mr. Aniola, can you, in the case of Nigeria, what has been done to reduce the risk on tax avoidance for the mobile banking subsector?
Thank you for that. Just to mention that one of the things the tax authority has been doing is to partner with some of the regulators in that particular sector. So for the mobile section, so there are instances where there's a new regulation from the CBN, for instance, that says that there's a charge for using like the mobile USSD service. So we are seeing instances like that where at the point of payment, the bank would now be the ones that are collecting on behalf of the government. So those kind of stuff, they will make the bank their agent in terms of collection. So they will now audit the bank to be sure that the bank has been withholding, deducting, and remitting the right amount of taxes. So in terms of administering it, what we typically see is that they will use the bank, because there's no how you deal with funds and inflows that it will not still be routed through banks. So the banks will take their charges and remit the taxes to the tax authority. I hope that's your question, and I responded to that.
Yeah, so let me just, yeah, thank you very much. Let me just also add up. Basically, tax authorities generally in West Africa are not sophisticated in terms of automation and technology, because that sector is an emerging sector, and withholding agent in the case that you just said about commercial bank being withholding agent for the tax authorities. You will still have a huge risk, because not every transaction will be at all by commercial bank if the platform is totally outside of the commercial bank operation. So I think what can be done mostly is to have some level of automation that will directly interface with the platform, and whatever trade that executed on the okay. So the next question, I hope that was enough. The next question is, can you throw more light on the situation where financial liability can be reclassified as an expense by the insurance company? Now, so this question, I don't know. So this question, the first thing, once you have a financial liability, it can only be reclassified as an asset, because a liability, every payment on a liability is an expense already. So in the accounting model, you have, if you receive, say, an insurance premium as an insurer, you debit the cash or whatever financial asset, you credit a liability. So whatever associated payment on a liability is a form of expense, a cash outflow. So you can only reclassify that liability as an asset if there's no more obligation to the insured party to pay that amount. So you can only reclassify from liability to asset, or asset to liability, or you can reclassify from expense to other comprehensive income. Or so if I understand your question, where is there can be no reclassification in this instance, because a liability is already okay. Sorry, I was locked off. So yes, the standard require a redesignation of a liability as an asset. A liability that was previously recognized on the books as an asset if there is no more future obligation to delivery of cash or other financial instrument to the insured party. So that is the case with redesignation or reclassification. That is between asset and liability, and not between liability and expense. Baba say, may I know how an insurance contract can create an embedded derivative, and how that can pose a tax risk for the tax administrator? Yes. So, like I said, if the variable interest in terms of the recognition of the asset, the initial recognition of the asset and liability will always be equal. But then in a future cash flow, in terms of cash outflow, if the asset value is higher than the anticipated cash flow to the insured party, there'll be a variable interest there as we said. So that will be a form of derivative, and that is recognized initially at the date of the entry into the agreement. So if in a case that, of course, the rate, the discount rate is higher now. Discount has to do with cash flow that's recognized or that should be recognized in the future in present terms. So if the future cash flow, the net present value of the future cash flow is less than the asset value now, that means the future liability is less than the present value of the asset at recognition, then you give rise to a derivative, that embedded derivative. So for tax purposes, it is important to understand how these circumstances arise. And basically, it's based on the discount rate. Now, if the adjustment, the only adjustment is from from bottom up, meaning you take the base rate as the risk-free rate, and then you adjust for other non-cash, non-financial risk. Then if that amount is less than the effective rate, of course, you're going to have an embedded derivative. And for the tax authority, it is important to understand how these circumstances arise and what element will arise in specific case, whether it's an asset, because a derivative could be an asset or a liability, depending on which amount is higher than the others. I think we are out of time. So if there's no more question, thank you very much. And I hope you will take this lecture material and have much time to study and digest them. And also, I will also advise that you go to the standard. What I just gave you was just a summary overview of what the provisions in those standards are. But the onus is on you to actually go to the standard and see the specific provision, because first, for example, the definition, there are other definitions to search. So you can go and see the definition for embedded derivatives, contingent provisions, and what circumstances give rise to these things, so that when you see them in actual life, you can be able to recognize them, and you can be able to also apply the tax element. Let me say interest income on loan. Can you highlight on the reporting of financial statements for banks and insurance? So the interest income now for banks, there are two interests that result for example, the interest spread. So there's an interest they earn on the loans they issue to the public, and there's an interest they pay depending on the jurisdiction, because I know there are certain jurisdictions, and depending on the type of account, there could be an interest expense as well. So, but for interest income, it's based on the principal value of the financial asset, meaning the portfolio that's been given to the public. So if the percentage is, for example, maybe 10%, and over this period, then you can call an amortization, how you can realize that particular interest, because there's a whole schedule. You're going to have an opening balance, you're going to have an effective interest that you're going to recognize in a P&L. You're going to have the payment, which is a receipt from the borrower, and then you're going to have a carrying balance. So there are two elements there. You have the effective interest that is going to be recognized in the profit and loss. Then you're going to have the actual interest payment. These two things are not the same. But for tax purposes, is the actual interest that is received as going to be recognized for tax purposes, because the cash flow. The other one is just for accounting purposes, which is the result between the lending rate and the effective rate at a given time or as it relates to that particular borrowing. So it actually comes about based on the actual cash flow that the bank going to receive on the loan. All right, so the cash flow could be 10% of the principal value of the loan. That is what the tax authorities should recognize as income to the lender, to the commercial bank. And in the case of insurance company or loan, so there's an interest in a case. I know there's an interest associated with the liability recognition. Now, that is in some cases, if there's an agreement between the insured party and the insurer that the initial payment will accrue interest because because the risk level of the insured party, that could be a provision where the insurer is required to recognize an interest on a carrying value of that amount. So essentially, the amount received from the insured party is a liability. So it's not a loan per se, but a liability that has that can accrue interest based on the specific provision of the contract. So I hope that has. So there's no loan to the insurance company. There's only a liability that arises as a result of the receipt of the insurance premium. And in certain contract or in some contract, there could be provision where the insurer is required to recognize some interest on a carrying value of that liability. Yeah.
Yeah. Thank you very much, Mr. James. Apologies, I've been thrown out of the classroom by technology, so I'll be able to join you back.
Hello.
Hello, Mr. James.
Yes, okay.
Can you hear me? We're clearly running, behind schedule. We have time allocated for questions. I think what we do is just take note of those questions. When we come to the question and answer session, which you are part of the people to anchor it, those questions could be treated there. I think it's the best way for us to recover the lost time. Otherwise, we'll be here for longer than.
So that's fair enough. That's fair enough. And thank you very much. Thanks for your attention, everybody.
Yeah, you are welcome. Mr. Eniola, sorry for keeping you out for long. Yeah. You can go ahead and continue with the next session. That's the interpretation of the financial standards. You are welcome.
Thank you. So this is the second to the last module. Talks about the interpretation of the financial statement. My colleague James has done a very great job in giving you a bit of background for relating to the IFRS standard, which is the International Financial Reporting Standard. So I'll just go straight to the interpretation of financial statements. Okay. Now for the interpretation of financial statements. So in interpreting a financial statement, the first question that comes to mind is to state that who are the users of financial statements? So for the different users of financial statements, there are different things they want to see. For the internal users, for the internal users, they are what they need to see. For external users, such as investors, creditors, regulatory agencies, stock market, they are external users. In classifying the users of financial statements, there are two broad classes. There's first the internal user and the external users. For each of these different users, there's a key reason why they are looking at the financials. Now, how do we source for financial statements? For companies quoted on the stock exchange, any company quoted on the stock exchange is mandated to publish their financial statements. So once you go to the website or your Security Exchange Commission for your relevant jurisdiction or country, you likely would see that financial statement. So for the published account annual reports, information gotten from the government. So these are where you can see a published financial statement. We can just pick any company that is listed on any stock exchange. What you will notice is that that company would have its financial statements online. So there are key elements of a financial statement. You have the income statement, which is known as the statement of profit, the profit or loss statement, and other comprehensive income. You have the balance sheet, which is now based on IFRS, is known as the statement of financial position, while you have your cash flow statement. There are several IFRS, which James has discussed, that relates to disclosure items, line items in the income statement, balance sheet items, several standards that talks about all the line items that flows into the income statement, the balance sheet statement, and the cash flow statement. Just to give you an overview of what the income statement is, this is a report that shows the net income, which basically says this is the difference between revenue and expenses. So it shows the revenue received over time, cost of sale, and other relevant expenses. Now, for a typical financial institution, what you would likely see in the income statement is the fees charged, interest income. These are some of the things that are typically shown in the statement and in an income statement for a financial institution. Now, for a balance sheet, which is a statement of financial position, for a bank, for instance, what you typically see in terms of its net assets is the amount of loan that's issued. The loan issued is an asset to the bank. Then you see its liabilities, which would include deposit received from customers and placements and so forth. These are some of the typical line items you will see in a financial statement. Then you have the cash flow statement. So this just shows how the cash, that the flow of money, which are the cash payments. So for the cash flow, you typically will see two methods, either the direct or the indirect method. Best practice over time is that what we've been seeing in published financial statements is the indirect method. Now, the key components of a financial statement, like I mentioned, the income statement, you have your expenses, your revenue. Now, in terms of the simple accounting entry for expenses, you debit your expense and credit account payable. There are two ways to treat this. If it is a credit expense, you would typically debit expense and credit the account payable. While if the cash was paid, the expense account will be debited, while the cash or bank account will be credited. This goes in same for revenue. When you have a revenue or an interest income from a financial institution, the revenue bit of it is credited, while either the account receivable or the bank statement is debited. Like I just mentioned, to summarize, when you are faced and to say what are the basic accounting entries when you are checking financials, just to state that expense items are typically debited unless there's a reversal, while revenue items are credit items, are credit entries. Now, in terms of the components of the financial statements, what you would see here is that you have the balance sheet. I've given you an overview of what is in the balance sheet. The balance sheet is also based on IFRS. It's called Statement of Financial Position. So what implies is that what is in the balance sheet, you have your assets, you have your liabilities, and your equities. Accounting 101 then will tell you that your equity plus liability would equal your assets. So that's why you see that the statement of financial position would typically balance. What you would see is for your assets in a financial institution is you would see stuff like the loans issued, you would see investments in treasury bills, you would see government bonds, you would see typically all the investments the bank have. The investments the bank have would be, it can either be fair value through OCI, fair value through profit and loss. Fair value through OCI is fair value through other comprehensive income, fair value through profit and loss or amortized cost. Now that applies to for your liabilities, where your liabilities are measured at either your fair value through other comprehensive income or fair value through profit and loss. Then you have your equity. In terms of the equity of a financial institution, you have its capital, is tier 1 capital, and you have the other tier 2 kind of capital. For the cash flow statement, it's pretty straightforward, where you have your operating activities. Your operating activities are typically activities that involve the day-to-day transactions, which is your inventory, your current assets and current liabilities. Under your current assets and current liabilities, what you will see there would be your current assets, would be your account, your current account would be your receivables, your inventory. These are some of the things in your operating activity, the day-to-day activity. Then for investing activity, what your investing activity talks about is to say your current non-current assets. You look at your non-current assets, which is to say that you are looking at your property, plant and equipment, non-current assets, your land and buildings. These are your investing activities. While your financing activities will relate to equity. These are things that relate to your equity, which are instances of issues of shares, share premium, non-current liabilities in terms of payment of debts, payment of dividends. These are the items that will be reflected there. Now, here we're talking about the methods used in analyzing financial statements. So here we talked about like the 5 key common methods we've seen over time that financial analysts use, tax consultants use, tax administrators use in analyzing a financial statement. So when you get a financial statement, is to say, how do you analyze it? How do you make sense of it? What you've seen of recent is that financial statements are really voluminous. So you see a financial statement that has over 100 pages, over 120 pages. How do you analyze a financial statement? You talk about the horizontal analysis. Sorry, excuse me. For the horizontal analysis, common best practice, you would see a comparative. So if I'm doing the financial statement as of the year in December 2020, for a company that has been in existence over time, what I will see is a comparative, which is to say, this is the position as of December 2020, this is December 2019. Okay? So this is the horizontal analysis. Then the next point is the vertical analysis. For the vertical analysis, you would see that if you look at an income statement, a P&L, when you see the breakdown of a P&L account, what you would see is to realize that for the vertical analysis, the income, the financial statement would show, so let's have different items. Each line item is expressed as a percentage of the significant total. So if you're looking at the turnover, you're saying if there are 4 items, if fees and income, interest income, and two other line items. We are saying what percentage of the fees charged constituted to the turnover. So this is just to say the vertical analysis, saying picking a line item and as expressed as a percentage of a significant total. Now you now have common size statements, which is very rare, but it's typically used, especially when you are doing your loan analysis and they are trying to understand the cash flow of the company. You will typically see financial statements that only show percentage to say this is the gross percentage, gross margin, this is the net margin ratio. You have the common size statement. Now, for the trend percentage, you would see over a period of time, you see a 5-year period is one of the notes to the account based on the presentation and disclosures of financial statements. That for some section, you will see a 5-year trend of some of the key items in a financial statement. While your ratio analysis is just showing logical relationship between in terms of the financial single period. The ratio analysis is commonly used. You have like 4 to 5 ratios. You have your liquidity ratio, you have your current asset. So you have your Jerry ratio. There are several key financial ratios that you can use in analyzing a particular financial statement. So this is basically the summary of interpretation of financial statements that gives us an analysis that when we get a financial statement, this is how we're meant to analyze it. This is how we're meant to look at it. What I'm trying to do was try and call up some financial statement, but based on but I don't think there's any need for that. Okay. So the next module we'll be going into is the revenue and cost recognition. This is the last module. We need to state that in terms of accounting reporting, financial reporting, there's a set of formalized and regulated system that follows standardized principles and procedures. James had talked about IFRS. Accounting principles based on certain concepts and positions serve the role for accounting for financial transactions. These principles typically guide how financial reporting is done. Now, the principles which serve as a rule for accounting, I'm sure we've all heard that, is called GAAP, which is a generally accepted accounting principle. So there's a question from to say that on cash flow statements, what is the effect of decrease in stock to turnover? So there are several effects you have to look at it. On your cash flow statement, if there's a decrease in stock, what that implies is that your cash has increased in terms of your cash flow statement. So if your prior year stock was 50, and now what you have is 40, on your cash flow statement, that's a 10, which means that you've added 10 cash. So it is a positive on your cash flow statement when you are doing your operating activities. Now, in terms of stock in turnover, so I will talk about it from strictly a financial reporting point of view, because there's another perspective when you are doing marginal costing, when you are doing absorption costing and all those things, how it impacts your profit and all that. But from a financial reporting point of view, what that implies from what we've seen is that if your inventory is high, your inventory would be taken. So if you have a closing stock, your closing stock would be taken from your closing cost of sales. So if your cost of sales was 1,000 and I take a closing stock of 100 naira from 1,000, what my cost of sales would be 900. So what that implies is that the higher my inventory, the higher my net profits. So if my inventory increases to 200, my cost of sales would reduce with 1,000 minus 200, which will give me 800. What that implies is that I would have made more gross profit. My gross margin would increase. So one of the key things to review when you are reviewing a financial statement is the inventory. So thank you for bringing this point, is the inventory, because most times you would see that some institutions, they play with the inventory. When they do not want to declare a lot of profits, you will notice that the figure for the inventory would be excessively high. So what you are meant to do as a tax administrator is to say what constitutes your inventory, especially in cases where you are looking at an industry and over time you've noticed that a particular company's inventory is higher compared to the average operating in that industry. Then that should be a flag to say, if the inventory is high, then I think I need to narrow down on this inventory to say, why is this inventory high? Because the higher your inventory, vice versa. So I think that I mixed that up, but just to state that when you have instances where companies are having, in quote, suspicious inventory, you should question that. But thank you for that question. That was a very good question. Now, the accounting concepts are the basic rules, assumptions, and principles. Now, in terms of revenue and cost recognition, we're looking at it from two bits. We're looking at it from the accrual concept and the matching concept. Now, the accrual concept says that you should, which is some of the things when you're looking at revenue recognition, to say the revenue of that period, as the revenue that is attributable to that period, has it been recognized for that period? And also saying matching it. So there are instances where even though an income or an amount has not been paid, that does not imply that the revenue should not have been recognized. So when you are looking at it from a point of the revenue and cost recognition, you are just saying, have they accrued what they should do? Have they matched the income to the period? These are the key elements in terms of revenue and recognition. If there are any questions from this section that relates to financial statement interpretation, talking about revenue and cost recognition in terms of matching the revenue to the exact period, ensuring that the fees accrued for a period are shown in that particular period, we could ask that question, because what we've done is that we are done with this module, and we're on the module where we're dealing with any questions and answer, which is the general questions and answer. At this point, James could also come in if there are questions from the session that will not be answered, that has not been answered.
The question. So yesterday we had some questions that we did. So probably we just have, as a general question, we put them and ponder over them. So we also trust us that Mr. James has not been able to answer fully, and because of his presentation, they will also be brought forth within this session. So thank you very much. Mr. James, can you take the floor and answer those questions?
Okay, thank you very much, and thank you, Eniola, for that excellent presentation. All right, somebody asked earlier, what is BASA compliance? And of course, Eniola provided some beautiful answers. So let me just emphasize, to be BASA compliant as a financial institution is to comply with the two basic requirements, which is one, the reserve requirement for deposit liabilities and the asset coverage ratio. So the first thing is the reserve requirement. That is the percentage of your deposit liabilities that should be maintained as a current asset to provide for any settlement. So if you know, one of the reasons that led to the financial crisis was the banking rush. And what is banking rush? Banking rush is simply the lack of money in the bank when people go to withdraw their money or when people want money from the bank, even though they got money in their account, but the bank does not have money to pay to the customers. So the reserve requirement is a way to provide for that risk that there will be a banking rush. And, you know, so that's one. Number two is the asset coverage, all right, in terms of the exposure to other market risk or other non-financial risk. Because as part of the operation of the bank will also be exposed to non-financial risk, such as maybe disaster or the lost on loan portfolio. All right, so that asset ratio basically has two components. That's why when you're dealing with internal credit enhancement mechanisms, most times from the perspective of the creditor, the bank will require for some asset collateral in terms of securities, and, you know, to protect it against any future default. That is one. And the other side of it is that from the bank's own perspective, where like in case of a surety bond, so the bank will even require the borrower, which is a member of the public, to provide a surety bond to provide assurance or comfort for any future exposure. So those are basically, and like Inola said, those are generic Basel provisions. So there are specific guidelines per country where those requirements could either be stringent or they could be flexible depending on the jurisdiction and depending on the regulatory environment. But basically from Basel perspective is the reserve required ratio and the asset to liability ratio. Those are the two Basel compliance. Somebody also said, how may I know how the insurance contract can create an embedded derivative and how that can pose a tax risk for the tax administration? All right, so, and I gave a read out there, but let me just emphasize. So every insurance contract has two components. There's a host contract, which is the major provisions between the insurer and the insured. But there's also Or there may also be another component, which is based on the recognition of the cash flow, especially for the future cash flow, the present value of the future cash flow. If that amount is less than or equal to the carrying amount of the liability or the asset, that is essentially a derivative, which is a contractual right to others receive or pay that amount in the future. And the standards say you have to separate that from the host contract. So for tax purposes, it is important that the auditors understand the implication of the derivative on the insurance contract, which could lead to either an increase or a decrease in the tax obligation, depending on whether it's a debt or is a liability or is an asset, giving the recognition of that derivative. But in any case, for the tax auditor, it is important to understand the accounting treatment, because if you don't understand the accounting treatment, it is impossible to even determine whether that amount was fairly valued and whether the necessary interest income or the interest expense or whatever cash flow on that contract is to be recognized and the timing of the recognition. So those are three key elements that the auditor or the tax administration need to take into consideration. Then our Bajaha, sorry for the pronunciation if I'm not getting it right, but it's our. And our is asking, how does hedge transaction affect fair value of measurement in audit purposes? Now, every fair value or every hedge transaction is measured at fair value. And once you measure a transaction at fair value, there will more likely be either a gain or loss associated with that transaction. Because if the carrying amount of that transaction is less than the fair value, that will be a loss. And that loss in most tax jurisdictions, they are tax deductible, all right, because they are incurred in the ordinary course of that transaction. So they will essentially be recognized as taxable deduction. But on the other hand, if the fair value is more than the carrying value, then that will be a gain. And also some tax jurisdiction, you will have that being a taxable gain. So it is important as well that you understand hedge transaction, and there are three: fair value hedge, cash flow hedge, and the hedge of a foreign investment. So Baba said, just a follow-up. What should the tax auditor concern himself with by way of audit procedures in verifying the measurement of these embedded derivatives? Of course, why should you bother yourself with the audit of these things? Because they have tax implications. They will either lead to an increase or a reduction in the taxes payable by the reporting entity, the taxpayer. So the accounting procedure or the auditing procedure that is basically is inspection of records and mostly corroboration of the other side of the party. If there was a transaction between two parties, of course, there's a second layer of the transaction. So it's basically a zero-sum game. That means an expense or a loss to one party is a gain to the other party. So as a tax auditor, if you want to audit an institution that is recognizing embedded derivative as a result of some hybrid financial instrument, you may you may as well verify from the counterparty in terms of the payment or the receipt of that cash flow on the transaction. So, and it's important because if the taxpayer is claiming a taxable deduction, of course, you don't just want to give that deduction because you don't understand the transaction. You want to certify yourself in terms of all the evidence to support first the existence of the transaction, the recognition, the measurement, and and also the timing in terms of cutoff. So that is that. And then lastly here, okay, they were for Inuila, so I think I'm done. So, but okay, he said on cash flow statement, what is the effect of decrease in stock to turnover? Thanks. So cash flow statement is for cash receipt and cash payment in the organization over a defined period. So a decrease in the stock is a current asset. All right, so a decrease in a stock is basically an income. So that is an inflow as in the cash flow statement. But what a decrease in stock actually means on the organization is that stock, the decrease signifies a sale. So it will lead to an increase in cost of sale, essentially. All right, so again, Inuila said organizations will normally manipulate the accounting method in terms of accounting for inventory or depreciation or whatever for tax purposes, which is what we call aggressive accounting techniques, or somebody call it to cook the books. So in essence, what they will do is to understate the any inventory in the statement of profit and loss. And once you understate the any inventory, that will lead to an increase in cost of sale. And when there's an increase in cost of sale, that will lead to a decrease in profit. And there's a decrease in profit, that will be a decrease in taxes. So those are some of the accounting techniques they use. And the other way around is to increase beginning inventory. So if you increase beginning inventory, you will also increase cost of sale. And the reverse is to reduce any inventory. So two of them have the same effect on profit, but there are different ways to do it, and they will have the same net effect on taxes. I hope that has been fruitful, if possible. So I don't see any other question here.
Yeah, Mr. James, thank you very much for the wonderful explanation to those questions. I believe the questions were highly technical, but you have done justice to them as expected. So as I was saying yesterday, there were some questions posed by our first presenter, Vincent, though we didn't have time to look at them. So I think for us to do justice to them, I would like you to speak through them. I have reproduced them as a chat question. There are three of them.
Okay.
One is the emergence of fintechs represents a threat as well as an opportunity to traditional banking methods discussed. The second one is how well can banks and other financial institutions further embrace technology in the service delivery. Then the third one is highlight significant risks inherent in the use of technology in delivering services in the FSI's financial service industry. So please, what I want you to do is to shed more light, on the questions, for
Okay,
us to have
so
a
yeah,
straight
so the
perspective.
first one is the immersion of fintech. How does it
Yeah.
pose both opportunity and threat, right? Hello?
Hello, yes, that is the first one.
Yeah, so of course, the first is those emerging fintech, they are direct competitor to traditional banking services. So in a way, they pose a major threat. And I love the statistics that Inola gave at the beginning of his presentation, where he said that there's a fintech in the last 5 years, it has grown to become the number 3 player in the industry. So that is a huge threat to traditional banks that are not innovative in terms of the kind of products and services they are offering to their customers. Because customers want convenience, they want protection, they want other services, but major among the customers' expectation would be convenience. All right, and fintech provide a more convenient methods or mechanism through which people can transact using their money. So somebody can transact in the comfort of their living room or bedroom without going to the traditional commercial bank. They can take loan for a fintech without going through all that necessary paperwork that will take time. So that is a direct challenge to traditional banks. But there's also an opportunity because the emergence of these technologies do not prevent traditional banks to acquire and adopt them or to change with time, because of course, especially for COVID, COVID has taught us a lot of lessons, and the lessons are there for us to either benefit or to take them as challenge. But most times, innovation comes through difficulties when there's challenge. So commercial banks can see opportunity to deliver in terms of automating setting of their services, like maybe the requirement for loan application and all that kind of stuff could be done easily online without doing paperwork, or even the access to some of the services that are provided by fintech. They can also provide those kind of services and even provide better because they have that coverage and also maybe the capital capacity to acquire those additional add-on services. So that would be basically, but I see more of an opportunity if they see the light, the better side of things, because yes, though those guys pose competitive threat, but commercial banks can also tap into the emerging industry to improve their services to the public. What's the next question there? I hope that is clear.
Yeah, very, very clear. The second question is, how well can banks and other financial institutions further embrace technology in their service delivery? I think in the course of answering
Yes.
question one, you have also touched.
Question one, I also said that the bank can leverage the space, because there's a space that has been created now. Now there's a demand by the public for these kinds of services, the ease, the convenience, the security, and stuff. So financial institutions in general or banks in particular can further enhance their service delivery through technology, I know there are some banks that also have apps. Now they have apps. You can go to your Play Store or Apple Store and download the app, and then you can have online access to a number of services. I think that is a very good way forward than to see this thing as threat. So I see that as more of an opportunity than being a threat. So yes, commercial banks or other financial institutions like insurance company leverage technology in their service delivery. Highlight significant risk inherent in the use of technology in delivering services in the financial services industry space. Now, there are two major risks, I would say, inherent risk. Number one is the risk of failure of the technology, all right, especially when you invest too much capital in a emerging technology that may not serve your purpose. That would be a high risk, not just because of the damage in reputation, but the damage or the loss of investment. All right, and that risk essentially can be reduced by first running a trial version of the service, not to make it public. You have certain key customers, that will try the service, and in different forms, and then maybe you can go to a wider coverage of your customer base. So you can essentially get rid of that risk of failure of the technology. Yeah. And the other risk is the capital intensiveness of the technology. So some are very expensive to acquire and maintain. All right. So that's a risk that may prevent certain financial institutions for not acquiring those technology and delivering the kind of services that are expected by the public. All right, and those risks sort of they are inherent because they are resident with the organization. And maybe another risk that could also is the risk of not meeting the expectation, which is somehow likely related to the first one in terms of technology failure. But assuming that you provide certain services to the public and our services do not meet public expectation, so the demand for that service will be low, and the investment thereof now will be maybe a loss because the public is not interested in the kind of service you are providing through that medium. So those are some inherent risks, and you can do that. You can how do you hedge or how do you prevent such risk? Especially for the last one is through market survey, and survey of your customer base in terms of, we're trying to provide the kind of service, what's your interest? So you could do a generic customer perception survey to see how interested customers are in a particular service, and what leverage in terms of technology you can do as a bank or other financial institutions to further enhance customer satisfaction. So yeah, those three are good ones. Mr. Faisal.
Yeah, thank you very much for doing justice to these questions. I believe our participants have learned more from your explanation. So I don't know if we still have questions from our participants. Participants were encouraging you to ask questions, ask more questions, ask more questions. We have time to answer them. At least we have like 20 minutes before the end of this session. So while we are waiting for the participants.
Okay, so
hello, Mr. James. Hello, I said
I mean, so you can
question.
read as an expense, but
Yeah.
no, this one I always said this before. You cannot reclassify a liability as an expense because liability is already associated with an expense, so they have similar direction of cash flow. So what you can do, you can reclassify a liability that was previously recognized on the books as an asset. So there are two conditions under which you can do reclassification. One is that the conditions giving rise to the obligation no longer exist. So if there is no more obligation to deliver cash or other financial asset, then that liability in essence become reclassifiable. Or the other one could be that the condition has turned in favor of the organization. All right, so one is no more obligation, the other is yes, there's obligation, but it has changed in favor of the organization. So you can reclassify under those two conditions. Yeah. And then also, once you reclassify, all previously associated gain or losses will as well be classified depending on whether it's from asset to liability or from liability to asset. Yes, that is how the accounting provisions required. Thank you very much.
Yeah, thank you very much, Mr. James. And I want to make a very important announcement to the participants. By tomorrow, end of our session or before the end of the session, we are going to circulate a course evaluation form. It's very important that you give us a feedback as to how you evaluate the total program. There are sets of questions that requires your answer, and it's very key for us to learn where we need to up our games and where we need to maintain. We also do that, and this is going to be tied to your certification. I'm sorry to say that. So people who respond to it will be the ones that will clearly mark as those who have fully participated, and they will be issued a certification at the end of it. So please kindly take it very important and respond to it. Thank you very much. In the question and answer session, and questions are welcome from participants, either on the topics that were discussed today or the topics that were discussed yesterday. This program is a package, it's a total package, so it's not segmented as the way the days are. If you have any question, it's a continuation. You can ask it, and our judges would, rather our facilitators will give you answers to the best of their knowledge. Thank you very much. Mr. James, are you there?
Yes, I am.
Yeah, it appears that we have one question. You look at the question answer box.
Okay. What are the types of risks that can arise from insurance contracts? Is that the one?
Well, 142, that's the one that is the latest, the most current.
Okay,
So that's the
142.
one from our Baba Bajaha.
So from the insurer perspective, the major risk would be that the future cash flow, the payment will be more than the asset, which is you pay more than the insurance premium that you received. And that is basically the most adverse situation where the insurance claim by the insured party is more than the insurance premium pay. The other risk is actually in terms of the volatility of the exchange rate and also the interest rate. And those two, of course, they have significant impact on the carrying value of the asset or liability on the books. So if there's an average change in the interest rate, for example, that will affect the present value of the future cash flow. And that in essence will also increase the provision for gain or loss. And the worst case is for a provision for loss to increase. So.
Yeah, thank you very much. Another question is there.
Please, what type of risk is COVID-19 creating in a sub-region?
Yeah, that is one. There's another one. What continuous charging of interest on unpaid loan balances for years? How is that related to fair value? The question is not well crafted, but looking at it is that it is talking about continuous charging of interest on unpaid loan balances for years, and how does that relate to fair value? Maybe you can.
So I'm not seeing a question, but from your reading, let me just. I'm not seeing a question, but from your reading, let me just give my. So I think what the person is asking is, especially for tax administrations, there are tax liabilities on the books, and per the revenue legislation, there are interest and penalties on those amounts. So as long as the revenue outstanding, they keep charging interest and penalties on those amounts. So the first thing is, it's going to unrealistically overstate your asset, all right, because the interest is an interest receivable, which is an asset. It's also going to overstate the income, because you debit interest receivable and credit interest income. So that is, first of all, in the accounting provision, that's an impairment. So once the money is not being paid, all right, per the due date, all right. So in essence, the standard requires that you recognize it as a loss. All right. So that is the key. The key is when there's a default, meaning when the amount payable is not paid on the date on which it is due. And so even from the regulatory perspective, in the case of commercial bank, for example, if there was a loan to the public and this loan is not being paid, or the interest just accruing and not being paid, of course, you have to recognize a loss, because in essence, the customer has defaulted, So that is the treatment. So you have to recognize an impairment loss in the case of commercial bank. And in the case of revenue authorities, although tax debt you have on your books where the taxpayer is not paying. And of course, in some tax laws, there are times where after the passage of certain time, you have to write off those tax debt and the associated interest and penalties as a loss. They're no longer collectible. And if in the future you having to collect them, you can just reinstate them and reverse the transaction and pass the accounting entry. So that's a simple treatment. But in a case where it's not being paid at all, the standard says you should recognize an impairment loss. So thank you. Any other question? Faster, are you there?
Yes, I'm there. Thank you very much for that response to the question. Concerning the question asked about COVID-19, have you made an attempt
that
about
level of risk is COVID-19 creating in the sub-region.
in the sub-region? Yes.
When you say risk to tax authorities or risk in general, because we have to speak in context. But let me speak in terms of tax authorities, especially where the services are not automated. It presents a huge challenge for tax administration, where the public have to directly have physical interaction with the tax authorities, and because of the social distancing issues, you will see that there are some taxpayers will have relevant reason why they not come and pay their taxes.
What do you need to assign him? Is it his?
Hello, is there?
Hello, yeah, I can hear you.
All right, so yeah, but if the services are automated, where you have e-registration, e-filing, e-payment, of course, the challenge to any administration will not be that much, even though, of course, because the businesses are not operating to full capacity, the economy is not performing well, that's going to affect the taxes going to collect. So there's going to be a whole circular effect from the reduction in sales to the payment of taxes. You're going to have a ripple effect, but that will only be minimized if you have automated services. And of course, in the sub-region, we are way under. We are not well automated in terms of the way, say, for example, the East Africa and other African sub-regions.
Yeah. So thank you very much, James. I can see another question popping out.
Okay.
It's still from Lamin Gambia. It says unclaimed insurance refunds in case of comprehensive insurance policy. How will it appear on financial statement? And can you talk about brown card fund paid by insurance holders and its reporting? So, have you seen the question?
Yeah, I've seen it 149. So unclaimed insurance refund, that is essentially a liability to the insurance company, all right? If it has been verified that the insured party actually has entitlement to the claim and the amount has not been paid, of course, that first of all goes to the statement of financial position as a liability and the associated loss. Now, there will only be a loss if the claim is more than the asset. All right, because if the initial liability that was recognized, say, for a particular insurance contract, say, is 100, and then they claim, they will claim a refund is more than 100, that will lead essentially to a loss. So that will be in addition to the initial liability. You're going to pay an amount that was not initially recognized. So there will be a direct loss on that transaction. So he's saying, how will it appear in the financial statement? It's going to appear as a current liability, because normally claims are paid when verified, especially they are not long-term, they are current liabilities. Okay, how can you talk about brown calf refund paid to insurance holders and age reporting? So those are also direct cash flow. They will be expense. Those are expense directly in a statement of profit and loss. Yeah, those are profit and loss items. Those are not balance sheet items. Those payments to the policy holder will go directly to the profit and loss, because they are associated with the contract. They occur in the normal execution of the contract. So they form part of the transaction cost. And transaction costs are normally expensed when they are incurred, especially when those claims are value are fair market value. So yeah, that would be the treatment.
Yeah, thank you very much, James. There's another question posed at around 1:53. The question is, why is Basel IV not being in use in West Africa? I think Basel IV has to do with increasing capital requirements. Is it not used in Africa?
So there are graduation process for each level of Basel compliance. And even for Basel III, we still struggling with a lot of issues in West Africa. So, and you know, most times in West Africa, we are last to adopt certain, what should I say, certain changes in certain industry. So, but I see no reason why that should be the case. But regulators, the questions should be to the regulators. I don't have any reason why they will not be required to comply with Basel IV. So
yeah, I think that is also my thinking. Probably the question is not,
yeah, I know.
you know, well stated. Yeah.
Yeah. So if that's the question, then it will be the case of the regulatory environment, what the regulator require for compliance.
Yeah. So thank you very much, Mr. James, for making it possible for us to hold this training session for today and going an extra mile to answer several questions that are highly technical. I hope our participants have been able to have some takeaways, and we hope tomorrow when we reconvene, we'll also continue with the other segment of the training. For now, we have come to the end of today's session, and I believe each and every one of our participants will want to continue on with their daily routines, as well as the presenter. So I once again thank you very much, and our team, you know, of officials in the, I mean, at the West African Tax Forum Administration Forum, WATAF Secretariat here, who have been tirelessly putting heads together to make sure that we are able to handle the session. A big thanks to you all, and also to the Executive Secretary for patiently being with us from the beginning to now. So I hope to see you tomorrow. Thank you very much. I have the best of the rest of your day.